Hello again from a cold and wet Cape Town. The winter rains have started here, so we're happy for that in terms of filling up our dams again. I hope you've kept well through the lockdown, and if you're a business owner that you've been able to start up again, and if you're an employee that you've been able to get back to work. We're going to be talking about the month of May and what happened in the markets, and I'll spend a bit of time as well just talking about how things look at the moment compared to where they were at the beginning of this year, and then having gone through the really difficult time in March as markets pulled back on the back of the lockdowns from coronavirus, both in South Africa and around the world. It's quite clear now that the world economy is going to be smaller at the end of this year than it was at the beginning. Estimates at this stage around 4.5% smaller. The US economy is expected to shrink by about 6.5% for 2020. Europe a little bit less than that. Japan also around similar levels to Europe. China is expected to be marginally positive, around 1.5% up. And the South African economy is expected to shrink by between 8 and 10% for this year, all on the back of the shutdowns from the coronavirus. If we have a look at next year, there's expected to be quite a sharp increase of around 5% of predictions at this stage of economic growth for 2021. So making up some of the pullback that we've seen this year. Two other economic things just to take into account and that we saw during May. One is we do expect to see continued noise and tensions between the US and China. One, because it is an election year for Trump, and we expect to see the continued arguments, whether it's around corona or trading terms, to continue, and that creates volatility both in global currencies and in global markets. The other thing a bit closer to home is what the Reserve Bank can and is doing with interest rates. We saw another 0.5% cut of interest rates in May, and we expect, because inflation is so low, and a large one of the feeders into that is the oil price globally, which remains low, we'd expect to see possibly another 1% cut before the end of 2020, just to try and support the economy and to support business and consumers and to get the economy going. After a very strong April, the equity markets in May were quite muted. Global equities were up about 0.6%, South African equities up 0.3%. The local listed property market in South Africa was down marginally, 0.8% down. But big jump in May was the South African bond market, which was up over 7% for the month. The equity markets globally, we saw emerging markets down more than the developed world, but South Africa stood up well and was actually positive during that period, while emerging markets were down over 3%. The rand strengthened somewhat during the month as we saw it get to way too weaker levels above 19 rand to the dollar, and we expect it could continue to strengthen further from here. At a presentation earlier this week with the Chief Investment Officer of Credit Suisse, he made the point that isolated events are very difficult to protect against. And what we've seen now is an isolated event in that we haven't seen something with this big a health as well as economic impact happening for over 100 years since the Spanish flu. The only way to protect against those things is to diversify, and our portfolios are well diversified, and it's been something that we've always used in how we manage our clients' money. So diversified across asset classes, property, equities, cash, bonds, both locally and globally. Diversified across regions, we've got those investments all around the world. And diversified across managers, so that we have people who are good at managing bonds, for example, people who are good at managing cash, people who are good at moving between the two and putting those together into our clients' portfolios. This strategy definitely helped through the crisis. Some equity markets during March were down over 40%. Our most aggressive portfolios at one stage were down about 20% in March. But we've seen those things by and large making up all those pullbacks in return have been made up as we speak right now. We've seen quite a strong run in equities at the beginning of June, and those more aggressive portfolios have benefited well from that. So what can we learn from this? At the end of March, in the video, we showed the slide where we looked at our flexible fund, which is our most aggressive strategy, and showed how that in the 2008 crisis had lost ground and then made it up again, and the risk of pulling out when markets were low. And we've seen the same thing happen again. The Flex Fund earlier this week was actually positive year to date, having been down quite dramatically in March. So market volatility is not going to disappear. The Rand has been a good example so far at the time of recording in June. In the first 10 days of June, the Rand strengthened by over 10% against the US dollar. Different markets are going to have that kind of volatility at different points in time, but the diversified portfolio with a long-term focus will reward you and your wealth will grow through time. Looking forward, if you ask me for the next 5 years, what are our expectations of returns over the next 5 versus the last 5? I would expect to see better returns over the next 5 years because valuations are quite attractive in a number of markets globally, and the stimulus that's been put to rectify economic growth after the corona crisis all will play into helping share markets perform better over the coming 5 years, we think. Stick to your long-term strategies in a well-diversified portfolio with good underlying managers, and you'll be rewarded. If you've got any questions, as always, please give us a call. We have always been open, and we'd love to chat to you. If you want to download this report, you can do so from the website. Until next time, keep all the safety measures going, wash your hands, wear your masks, and we look forward to seeing you again sometime. Thanks very much.